Let's talk about dividends. Remember when we had the sole proprietorship, the owner took money out through owner's drawings. Well, dividends are the corporate version of owner's drawings. A dividend is the corporate distribution of cash or other assets to its owners, and its owners are the stockholders, and they distribute that dividend on a pro rata basis. So if you own 100 shares, you get twice as big a dividend as somebody who owns 50 shares. So before a corporation can declare a dividend, it probably has to have retained earnings. Most states won't allow you to pay a dividend if you don't have a big enough balance in retained earnings. It's certainly going to have enough cash if they're going to make a cash dividend. And they're certainly going to have the board of directors declare a dividend. Now, dividend policy is a topic for finance class, but let's talk about it just for a second. Let's take a look at the grocery store Winn-Dixie and its dividend policy in the 90s. So in 1994, they've got some good same-store sales increases. That's an important measure in the retail industry. Your stores that were open 2 years in a row, what happened to the store sales? Did they go up or did they go down? And 2% is a nice, healthy same-store sales increase. So they pay out $100 million in dividend. Next year, same-store sales increases are up, sales as a total are up, net income is up, and so their dividends are up. And they spent more money on their store system. So all is looking good. Now things start to go a little bit bad here. They got good, strong same-store sales increases. Sales are up again. Net income is up again. So they raise their dividend again. They're paying more and more dividends, but they cut back on their spending on their stores. They spent $10 million less than they did the year before. So same-store sales go down. Sales as a whole are up. Net income is down. But now the dividends are still going up. So it seems to be important to the Winn-Dixie Board of Directors to declare an increasing dividend every year. Next year, same-store sales are negative. This is bad. Sales as a whole are about flat. Net income is down, but dividends are up again, and spending on their stores is down again. So they're spending money on dividends instead of stores. Same thing happens the next year. Same-store sales are down. We've got net income down, but what's happening to dividends? Dividends are up, and spending on the store system is down. So what happens to Winn-Dixie eventually is they keep spending money on this increasing dividend stream, so their shareholders are happy to open up a check every quarter that's a little bit bigger number than last year at the same time, but they're not investing enough in their stores. Eventually they go through bankruptcy, and eventually they're bought out by somebody else in 2012. So the lesson there is to be very careful about the dividend policy. So you may have a lot of money in the bank right now, and so you can write a check to your shareholders for dividends, but you better make sure that you can maintain whatever dividend policy you establish indefinitely. Otherwise, your shareholders are in for some bad surprises, and nobody likes bad surprises. So dividends are often paid quarterly, and there's 3 important dates. There's really 4. There's the declaration date. That's the date that the board of directors authorizes the dividend. There's the payment date. That's the date that the checks will be cut. And then there's the record date. So in this example, on December 1st, the board says, we're going to pay a dividend on January 20th to anybody who owns the stock as of December 22nd. And then there's a thing called an ex-dividend date. A couple business days before that, that's the cutoff date. Because in between, say, the 18th and the 19th here, there's a lot of shares changing hands. So to make it easier on the stock transfer agent, the deal is the stock trades ex-dividend, without the dividend. So if you buy the stock on the 18th or the 19th, you're too late to get in time for that 22nd deadline. And so what happens to the stock, by the way, when it goes ex-dividend? Well, it trades for a little bit less. The dividend isn't coming to the person that bought those shares, so the stock price takes a little bit of dip on that date. Let's say the company has 100,000 shares outstanding on December 1st. The board of directors declares a cash dividend of 50 cents on each of the 100,000 shares. 50 cents times 100,000 shares is $50,000. So they debit cash dividends. Remember, owner's drawings started with a D? Well, dividends starts with a D. That reminds us that owner's drawings and dividends are both accounts that increase with debits. So we debit cash dividends for $50,000. We credit dividends payable for $50,000. There's also such a thing as a stock dividend. That's where we just give our shareholders more pieces of paper, and we'll talk about that later. But this is a cash dividend. We're going to write checks for $50,000. Then on December 22nd in this example, that's the record date. Shareholders of record on that date will receive the dividend on January 20th. There's nothing for us to record on the ex-dividend date, which is 2 business days before the record date, or on the record date. These are just record-keeping matters about who is going to collect the dividend. Okay, now it's January 20th. It's time to pay the dividend. Why don't you pause this video and see if you can create the journal entry on January 20th. Okay, I hope you got it. We take that liability account, dividends payable, off our books with a debit of $50,000, and we credit cash for $50,000. Cash is an asset. It increases with debits and decreases with credits. Perfect. So in summary, to pay a cash dividend, a company probably has to have a high enough balance in its retained earnings to make that cash dividend payment. Most states require that. Absolutely need to have enough cash. Remember, retained earnings is not cash. You have to have enough cash to make that payment, and you probably want to have enough cash in the future to continue making that payment. And your board of directors has to declare the dividend and has to set a record date and a payment date. And that's all there is to cash dividends.